Welcome to this explainer. Okay, today we're exploring what is honestly the ultimate paradox in the business world. Why is it that highly profitable companies can still go completely bankrupt? Well, the secret lies in uncovering the true financial story right beneath the surface numbers. We need to understand the absolute reality of cash flow.
All right, let's dive right into this. The core thesis of our journey today is perfectly captured in one simple phrase. Untung tidak sama dengan tunai. Profit does not equal cash. You see, profit on paper is kind of just an accounting illusion. It's a theoretical calculation that absolutely does not guarantee a company's survival. Cash, on the other hand, that is the undeniable reality.
So here's our quick roadmap for today. First, we'll look at exactly why cash flow matters. Then we'll break down the three main activities, compare paper profit against real cash, unpack 6 key formulas, and finally, we're going to apply the whole shebang to a real-world case study.
Section 1. Why cash flow matters. Evaluating true health.
Cash is literally the lifeblood of a business. We look at these 6 specific metrics to evaluate if a company's core operations are truly self-sustaining. It helps us assess the actual quality behind those paper profits, and honestly, most importantly, it helps us spot early warning signs of liquidity traps. This is exactly how we figure out if a company showing record earnings is actually secretly running out of money and about to hit a brick wall.
Moving on to Section 2. The 3 main cash flow activities. Main cash flow parts.
All right, think of operating cash flow as the actual engine of the business. It's the cash generated or burned in day-to-day primary activities. If this number is positive, it tells us the engine is incredibly healthy and self-financing. The company is actively bringing in real money simply by doing what it was built to do, without needing to beg for outside help.
Next up is investing cash flow, which is all about fueling the future. This tracks the purchase or sale of long-term assets. Now, here's a really crucial strategic insight. A negative investing cash flow isn't always a bad sign. Actually, it's often a fantastic indicator that a healthy company is actively buying assets. Things like heavy machinery, new tech, or land, all to secure and scale its future growth.
The third piece of the puzzle is financing cash flow. We can really just think of this as outside help. It records the cash moving between the company and its external financial backers, so its owners and creditors. This shows us their overall capital strategy, which involves things like taking out new bank loans, issuing fresh shares to the public, or maybe rewarding existing shareholders by paying out dividends. Section 3. Net profit versus real cash. The reality check.
Now, under the rules of accrual accounting, revenue is recognized the exact moment it's earned. Imagine making a massive RM 100,000 sale on credit. On the income statement, wow, you look rich. But until that client actually pays up, that profit is basically monopoly money. The business hasn't seen a single real cent yet, meaning it could literally be starving for liquidity. It just goes to show the incredibly dangerous gap between paper profit and real cash.
Section 4. 6 key cash flow formulas. Unlocking the numbers.
We use these 6 specific metrics as a company's vital signs to form a complete financial picture. We check immediate liquidity with the operating cash flow and its ratio. We gauge long-term solvency against total debt. We look at free cash flow to see their financial flexibility. We check the ratio of operating cash to net profit to reveal true earnings quality. And finally, we verify that shareholder payouts are actually sustainable through the cash dividend coverage.
Now, financial pros don't just guess at business health, right? They use a very structured, chronological 6-step analysis. First, always start with the operating cash flow. Second, compare it to net profit to check for earning quality. Third and fourth, analyze the investing and financing activities to understand exactly where external capital is moving. Fifth, evaluate the free cash flow for ultimate flexibility. And step 6, this is a big one, zoom out and check the multi-year trend. A single year is just a snapshot, but a multi-year trend, that tells the real story.
By looking at combinations of positive and negative flows, we can literally decode a company's entire life cycle. It's like a giant puzzle. For instance, positive operations but negative investing and financing, that right there is a mature cash cow, actively investing in itself while paying down its debt. But what if you see negative operations paired with positive investing and financing? Major red flag. They might literally be selling off the office furniture and borrowing heavily just to keep the lights on.
Section 5. Case Study Sharikat Maju Berhad.
Okay, let's look at Sharikat Maju Berhad. They reported a net profit of $200,000. But look at this. Their operating cash flow sits at a very healthy $250,000. The cash generated straight from their daily operations is actually outstripping their reported profit. This is a phenomenal indicator of high-quality earnings, meaning their daily business is churning out some serious liquidity.
When we run the formula, dividing that operating cash flow by the net profit, we get a multiplier of 1.25. This proves that every single dollar of profit they reported on paper is fully 100% backed by real, tangible cash from their operations. Plus, they've got a comfortable 25% buffer to spare.
Next, we check on dividend sustainability. They paid out $50,000 in dividends against an operating cash flow of $250,000. So, their operating cash flow is 5 times larger than their dividend obligations. This means those shareholder payouts are rock solid. They can easily be sustained over time without completely starving the core business.
So the really crucial part is figuring out what's actually left over at the very end. After accounting for $160,000 in heavy capital expenditures, which means they're investing heavily back into fueling their own future, they still have $90,000 in free cash flow. This is their true financial flexibility. This is the exact capital they can use to weather economic storms, pay off unexpected debts, or just pivot to brand new opportunities.
As we wrap up this explainer, I want to leave you with one final, provocative question. Adakah keuntungan perniagaan Anda benar-benar menghasilkan tunai? Is your business's profit truly generating cash? The ultimate lesson here is that while profit shows your performance on paper, it is real cash flow that dictates your ability to live, move, and grow. Thanks so much for joining me on this deep dive.